We'll now go through the next step after recording the transactions, which is step 3, posting from the journal to the ledger. For our purposes, as I said earlier, we'll be using the T accounts as our ledger. So we'll go through and set up these T accounts for all of the accounts that we create or that we use in our journal entries, and we will post there. So posting is just transferring or copying the data from a journal entry into the ledger. So it's nothing new, we're just looking at it a different way. And each ledger or T account will track all of the transactions for that specific account. So the journal and the ledger are two different ways to track the same information. So we'll write that here. Oops, sorry. The journal and the ledger are two different ways to track the same information. So the journal, which is where all of our journal entries are, this is sorted, the information sorted by date. So each transaction sorted by date. TRXN that I just wrote there, that's just my short for transaction. So each transaction sorted by date. And then the ledger are transactions sorted by account. So I bet somebody's like, well, why do we have to do this twice? Isn't just doing it in one place good enough? Well, there's definite reasons why we need both. So the journal entries, all of these transactions in the journal, we need those so that we can see the full transaction. We know both sides to tell us what happened. So if we look there, we see each account impacted in a single transaction. We know here, for example, the company received cash as an investment from the owner. So it hit cash and it went to the capital account. We know why we got that cash. Now looking at the ledger, so it's sorted now just by accounts, you can see that down here. We will just see all of the different transactions that happen in cash. So now if we quickly want to see that, well, where did all our money go? We see cash here. Maybe later we see a credit of $100,000 where cash was going out. Then we bought some supplies for $10,000, another credit. We did some work. We got paid $5,000. So it's now looking at all of the transactions for one account. So that's also useful information. And in particular, we can quickly calculate what the balance in this account is, which we'll see in a minute. So both have a use that is very important, and therefore we need to do both of these. And you can see here in this example they've got from the textbook that it's just copying or moving the amounts from the journal entries into these accounts. So every time you do a journal entry, you would take the debit on the left, put it in the necessary account. So we can see here, cash was debited, so it went on the left side, which is our debit side. We had a credit to capital from our journal entry, so we credit, which is the right side of the capital T account. So we're just moving that information to a new place. So we now can keep continuing the examples we've been looking at. So in our first entry, well, this is just poor spacing. I'll just move this over here quick. So we bought inventory with cash. We had a debit to inventory, a credit to cash, and the journal entry on the 10th, we, sorry, poor spacing again. We debited the truck when we bought it, and we credited the bank loan payable for $30,000, which was that new amount. And up here, I've also given you guys opening balances that we'll use. So a T account will have an opening balance. It will go through all of the transactions, and then we'll calculate an ending balance. So first off, we'll just start, it's right here first. We'll start with the cash account. So we'll just go ahead, draw a T account for cash. If you guys want to do this, I left a blank space for you on the next page, so you could do this here or there. I just want to be able to see all this. So we'll start with cash here. We have an opening balance, a debit of $10,000. So what side will that go on? Right, debit's on the left. So we'll put the $10,000 here. And it's good to label each entry that you have in a T account. So we can just put BAL to show that this is our opening balance. Now, we also have inventory as the next account, and these are the ones impacted by our first journal entry. So we'll open these up. Now we can see here, inventory has an opening balance at the start of September of $3,000, also a debit. So again, that's on the left. So BAL to show it's our opening balance, $3,000. So let's go ahead and we'll post our first journal entry here. So we debited inventory. So we'll just move this down to our inventory account. And again, you want a reference. So we'll just put here September 1st. So if we want to, later, if we're just looking at the inventory T account and we see that $4,500, if we want to know what journal entry or look at the full transaction, we quickly know, go back to the September 1st page in the journal and we can find the full transaction there. So that is why we do those references. Now, as part of this entry, we also credited cash for $4,500. So a credit on the right. So we'll now put it on this side of our T account, $4,500. Again, we can label this September 1st. So when we're looking at that, we know. Okay, so that's cash and inventory. Now let's go ahead and look at our truck and our bank loan account. So we set up the truck T account and our bank loan payable. So the truck has a zero balance, and it's not a bad thing to show this. So we typically would start, if it's a zero balance, with where the normal balance would be. Remember, truck is an asset. To increase an asset, you would debit it, which also means that is the normal balance. So our normal balance for a truck would be zero. Put that there. For the bank loan payable, our opening balance was a credit of $13,000. And a bank loan payable is a liability, and the normal balance is a credit. So it makes sense that we're starting with that. $13,000. Again, it's our opening balance. If we post the transaction, so we're looking at our second one here, we've got a debit to the truck first. So on September 10th, we have a debit of $30,000. And we're crediting the bank loan payable account for the same $30,000. Right, so we posted these now, they're in the T accounts, but we still need to calculate our ending balance. So if we flip back to this page, draw a line off here to show we're calculating a balance. Now for cash, where we have a debit and a credit, here you need to find the difference between each side. So we take our $10,000 balance, or our $10,000 debit, sorry, and the $4,500 credit, and we figure out the difference. So the difference between those two is $5,500. And because our debit is more than our credit, the balance left is a debit balance. So you're subtracting those, and whatever's higher is where you leave your balance. So we have this $5,500 balance here. For inventory, because they're all debits, so both are debits on the left side, we just add them up. So the balance here is $7,500. So those are the two there. And if we go to our truck account, again, just the one. So we have a balance of $30,000. And in our bank loan payable, two amounts, but they're both credits, so we're going to add them. And we're left with the balance of $43,000. Now, you should note here as well that we need to have offsetting, or our balances need to have debits equal to credits. So you can see that here. Cash, $5,500 plus $7,500 in inventory plus $30,000 in the truck account equals $43,000, which is our credit balance in the bank loan payable. So overall, your debits equal your credits. Okay, so that is posting to the T accounts. We're just moving the amounts from our journal entries into the related T accounts. Once you get to the end of a period of time, you calculate a balance. And then we'll look in our next video at the final step for this chapter. So step 4 will be creating a trial balance.